and gentlemen, everyone says Africa is the future. But if you had to write a check today, real money, real risk, where would you put that? And why? Because here's the uncomfortable truth. Africa isn't competing with Africa. It's competing with the rest of the world for capital. Now, a quick disclaimer. If you're here for polite, safe, diplomatic answers, this is your moment to exit. We will not judge you. But if you do decide to stay, fasten your seatbelt, because this is a panel about real money, real opinions, and real risk. And we have 3 people here. They invest in it, they build it, and occasionally call out it's nonsense. Amongst the 3 of them, we have an investor who is building one of the most ambitious hospitality platforms across sub-Saharan Africa, backed by serious institutional capital and betting on long-term fundamentals in a short-term world. We also have someone who's helping stitch together a Pan-African portfolio in a market where scale is notoriously hard, and doing it through partnerships, not playbooks imported from elsewhere. And finally, everyone's heard from the geopolitical strategist who reads the signals before the noise and who understands that today capital doesn't just follow returns, it follows risk, narrative, and power. So not a theoretical conversation, we hope. This is capital conviction and consequences. Please join me and put your hands together and welcome Buhle Ndlovu, who's a principal with Kasada Capital Management, Ewan Cameron, who's the Director of Africa for Westmont Hospitality, and you've heard from Ronak Gopaldas, who is the Director at Signal Risk and Visiting Fellow at LSE. Thank you. Shall we just start with the elephant in the room? Although given we are in Africa, it is an interesting analogy because we know that elephants don't stay in the room in Africa. They're out in the wild, and when they do move, the entire ecosystem shifts. But I do want to ask about what is politically hovering around, rather I should say politely hovering around every conversation these days, the war in the Middle East. And it's not just geopolitics, right? It's oil prices jumping, it's flight paths bending, it's supply chains stretching, and investors suddenly remembering what risk feels like. Whoever wants to go first, I would love each of you to answer. Not what we are reading in the headlines, because we've been there. What's your read? Probably the stuff beneath, the second, third order effects. What's no one talking about yet? And please tell us one upside for Africa and one downside which might derail this growth story, as we all know. Who wants to go first? Ronak? Okay, let's go.
So look, I think we're dealing with an unpredictable, theocratical, belligerent regime. And then you've also got Iran. We're dealing with a multi-dimensional conflict over here. You've got 3 questions, 4 actors, and 4 theaters in my mind, and of course Africa is going to be affected. So the 3 questions for me is, does this stay an isolated war, or does it become a regional or an international war? And that is quite clearly what Tehran is trying to do, is escalate. This is what the GCC attacks were all about, is to make this widespread, to get the contagion going, because they can't compete militarily. Second question is around the Strait of Hormuz and the oil prices, right? So how long will it be closed? Is this fundamentally going to be reset? And are we going to be in an environment of higher for longer oil prices, shortages, all of that kind of stuff? And I think we're starting to see, as we enter the 5th week of the war, that is very clearly the case. And then the third question is, what is the end game? Why did the US go in? Are their interests aligned with those of Israel? And there seems to be an incompatibility because we hear something different every day. So 3 questions, I think, which frame the duration of the war.
Yeah.
4 actors, all with different aims. So for Iran, it's about survival. It's existential. All they need to do is stay in the game for long enough and to play an asymmetric game of economic warfare. It's not conventional military. So that's their agenda. It's survivalist and it's maximalist. So it's kind of like a kamikaze approach. Then on the similar approach, you've got Israel. It's existential. They want to eliminate the threat of Iran. So they're not going to kind of go for a halfway house solution. The US thought that this would be a Venezuela type situation, but it has its own constraints, right? Midterms, markets, We know that when the gas price goes to $4 and when US Treasury yields go to 4.5%, that's when things get hairy and we see Trump caving or signaling or jawboning to markets. So, and then the missile maths, because Iran is firing cheap drones, and to repel those in the GCC countries and the US is very expensive. So it starts to become costly as we get closer and closer to midterm. So the US is looking for an off-ramp. And the same story for the GCC states. The entire model is predicated on safety and predictability and connectivity. So the longer that this goes on, it's not in their interest, but do they deal with a belligerent neighbor on their doorstep, or do they risk annoying their core security ally? And then the four theaters, and I'll wrap up after this, is you've got the economic theater, which is break down the global system. You've got the psychological theater, instill fear. So no ship is going to go through the Strait of Hormuz unless it's got kind of consent from the Iranians at the moment. And people are leaving Dubai and GCC countries because of the security story. Then you've got the informational warfare, and we hear mixed messaging from the US, but Iran's message is firm. It's about survival. And then the one, ironically, that matters the least is the military theater, because we know that there's a mismatch there, but it's checkers versus chess. All of this is to say, what does this mean for Africa? And I think there are three F words over here: food, fuel, fertilizer, inflationary shock, fuel shortages, massive implication for the cost of living, which is then going to have second and third order implications for socioeconomic realities and geopolitics. The upside, connectivity. As the global geopolitical map is being redrawn, as the map of international trade and mobility is being redrawn, I think there's a huge opportunity here, and we can expand on that a bit later.
I think what I find interesting is the four actors, the ability to take pain for each one of them is also different, which plays out in different ways.
Yeah.
The pain threshold.
Yeah.
Buhle, and then Ewan.
Let me just add on to that, I guess. Specifically, I think we're also dealing with really an underpriced geopolitical premium, right? We're sort of entering a phase of bringing it a bit closer to an investor and a hotelier more than anything else, is that you have this conflict, essentially in the Strait of Hormuz, that's really controlling or affecting 20% of the global gas and oil prices supply. You have within Africa, we obviously produce fuel, but more than 17 countries are net fuel importers.
Yeah.
Bringing it a bit closer to home, and really for an investor, what that really says is that you're going to be hit. Whether you like it or not, this will affect your bottom line, this will affect your P&L. You're looking at, from hotel operating margins, we're still fairly, across the board, across the whole continent, we're still fairly dependent on fuel for operations, unfortunately. So you're seeing that hitting your operational costs. You're seeing the price of tickets getting more and more expensive, which obviously affects your arrivals across the board, international and local. But you're also really seeing it affects construction prices. So one, you have this constraint that's not necessarily affecting just hydrocarbons. It's affecting a bunch of supply across the board. So you really are having construction expenses for new developments sort of getting a bit more expensive. I think the additional thing that perhaps obviously we can touch on a bit more is really around, perhaps for the last few years, I would say GCC sovereign wealth funds have really been some of the more ambitious investors across Africa. Very excited about mega projects across the board: construction, mega resources, hospitality. What you might actually see going forward is also the effect of really a redistribution of priorities of where to invest. So whereas the cycle, you're expecting a cycle going A to B, because of this, what they might be doing is looking a bit more inward. And in that sense, sort of prioritizing a bit more resilience within their own economies. So I'm thinking really security, energy, food systems. So within that, you really are seeing a shift, not necessarily of changing priority in Africa, but perhaps a bit more internally looking, but also perhaps a delay in sort of investment timelines.
I hear you. A bunch of downsides. I agree with all of the risks. One upside that we're probably not seeing
Do you know what? My favorite thing, one of my favorite words in Chinese is jihui. Jihui can mean one of two things, right? One, it can mean disaster, or it can also mean opportunity. So I think one of the stats I saw earlier on was really around you seeing there's a possibility that in 2026 in the Middle East, you're going to lose between, I'm going to say 11 to 24% of arrivals. That in itself could be an opportunity for African economies, right? If you're placed right, if you're considered, or people have the perception that you're somewhat insulated from the conflict. So insert Indian Ocean, insert East Africa, insert Southern Africa. That's really an opportunity to sort of, perhaps not obviously the whole pie, but even a percentage of that pie could be sort of redirected towards other African economies.
Excellent point. And look at the room around you. This is business as usual. Can't say that for other parts of the world. Ewan, upside, downside for Africa, and something that we're not reading.
Yeah, I think I'll begin by saying welcome to Radisson Upper Hill, which Westmont and its investment partners are pleased to have resurrected from a crisis. And I think Ronak's presentation with regard to the fact that every crisis creates opportunities makes it interesting with regard to what's happening in the Middle East. But I'm not an economist and I'm not a politician. From an investor's perspective, one of the big things that we think about is where's capital moving. And reality is that one of the biggest factors we have in humanity is the cost of energy. And here in Africa, we know that more pronounced than any other part of the world with regard to our disposable income and how much we spend on fuel with regard to transportation and energy at home. If the invasion of Iran manages to release that exportation of fear that Iran has historically had since 1971, that could be, to Ronak's point, a massive disruptor of how we see the global energy market. If we can see the fact that Venezuela, Iran, and other energy sources that we have around the continent becoming more open and becoming free trade, absolutely. If we could see oil moving to $40 a barrel, that would be a massive enabler globally, but it would be a pronounced enabler to us in Africa. The other scenario is it goes bad. The Straits doesn't reopen, we end up in a regional war, if not more, then the oil price could be $150 a barrel plus. That's a very different situation. So as an investor, I'm trying to think about where would the market be at 40 or where the market would be $150 a barrel. And that creates different headwinds and different opportunities. So to your substantial point, I'm optimistic with regard to the fact that today we've seen increased arrivals into Morocco. We're seeing increased arrivals into Kenyatta International Airport. Capacity was 91 at KQ in the end of February. Today it's almost 100%. So that Kenyatta International Airport is demonstrating that it maybe isn't as beautiful and as ornate as Abu Dhabi or Dubai, but it's a hub, and it's a hub with a trajectory of growth. So to me, that's where the opportunity comes. The downside risk, I said, is if the fact of oil and energy costs spike, that will have a disproportionate impact upon our markets.
Thank you, appreciate it. Ronak, you use the word chess because it's a bit of a chess game that's going on. And we can't deny the fact that Africa is now the world's chessboard when it comes to minerals, when it comes to the vital commodities. And both US and China are playing hard. My question is, how do African countries flip this into a power play where they're not just, they're not just being the board, but they are the players themselves? And how can this geopolitical gold rush actually, can it spill into hospitality and tourism investments?
Yeah, so I think leadership is key, right? And collective leadership, because otherwise, history is going to repeat itself. And we're already seeing in parts of East Africa and the Horn of Africa, Somalia, Somaliland, this divide and conquer stuff playing out. So unless we negotiate as either regional blocs or collectively as a continent to assert our agenda, the reality is that economically and geopolitically, we don't have the muscle to do this as a collection of fragmented individual countries, because ultimately, it's a might is right world. So I think that's the bottom line, is the integration story, the leadership story, the long-term thinking rather than short-term thinking is very, very important. And that's difficult because politicians look at short-term 4 or 5 year electoral cycles, and often, we're seeing it in Europe, it's easier to rail against immigration and integration, and that's the global zeitgeist at the moment. We're saying in Africa we want to go the opposite way. We want more integration. So it's a difficult sell politically, but ultimately I don't see any other way, right? To that point, it's not just the US and China. I think there are a broad range of actors over here. You've got the Turks, you had the Gulf states making a play, India, etc. So Africa in many ways is the belle of the ball, and everybody is courting us, right? So again, how do we exercise agency? Our demographics, labor advantage, critical minerals advantage, all of this stuff needs to be leveraged and negotiated in a way that's smart, that's savvy, that is long-term and commercially minded, which is, I think, where we're getting it wrong sometimes. Second part of your question was?
Was just how do you actually become a player instead of just an extraction economy, and it comes down to leadership, governance.
I think that's sorry, I was actually going to, I think that's so important, right? And we can't emphasize that enough. Sort of working within a framework where you have a government that's very clear about what they're looking for and where their tourism economy is going, having very clear KPIs of what you're trying to achieve, I think that sort of helps even from an investor confidence perspective to go, you might have these external shocks, right? But if you know that a government is very clear about this is where they're trying to go, you know how to support them in sort of getting there.
Speak to that a bit more, because Kasada has been buying brownfield sites like someone who doesn't believe in waiting for the perfect situation, pretty much, while everyone else is chasing the shiny new builds. So in African hospitality, where are you underwriting optimism and where are you quietly pricing in chaos? Who's doing it well? What's a template that people can, cut, copy, paste?
I think, honestly, a lot of people are doing it well. I think there's a few model countries where we're obviously a bit more comfortable and we see growth going there. Prime example, maybe touching on Morocco as a specific economy. And again, I think that touches one into the fact that the government is very clear about what they're trying to achieve. So 2030, they want to have at least 26 million tourist arrivals in the country. There's obviously a natural advantage to Morocco, as in general. It's got strong connectivity to Europe. You can't underwrite that. Even with the Middle East conflict, that's still there, right? They have a really good diversified economy or offering. So you're looking at a cultural pool, you're looking at desert, you're looking at ocean. So there's that diversification that sort of works really well. And you can sort of copy-paste that across quite a few other economies, to be honest. And then they also have a very clear way of, they've invested into particular passages. So think Agadir, think Marrakesh. And I think that's what you want to see as an investor, is that if this is going up, you have something to fall back on, right? We've been here before. Unfortunately, this is a very particular political situation, but we've been in situations post-COVID somewhat similar to this. And so that's kind of what we look for across the board. So Morocco itself has second highest pipeline in the continent. Even with this, you don't see that sort of changing, right? And I think as an investor, if you see a government that's very, that supports that and is very clear that that's where they're trying to head, there's confidence in that despite what's happening, you will get returns in the market.
And anyone you choose to name as just PowerPoint destinations?
All of them. I'm a huge fan across the board, so lots.
Excellent. Ewan, I want to pick up on what Ronak was talking about. We know there will be winners and losers in Africa. And it's not just about who has the minerals. It's about leadership, it's about governance, it's about discipline. So who is actually getting it right? Can you give us some examples of countries who are doing a good job of attracting investments?
I've kind of come to the view that the continent is absolutely a tapestry of different cultures and different visions. And absolutely, I believe with regard to comments that Ronak's made, with regard to the fact that collaboration is important and powerful. But clearly, there are countries in different trajectories. So I tend to group shakers and movers. Shakers are countries where, as an investor, you feel a little bit uncomfortable. There's not clear certainty. You particularly don't know what's going to happen with regard to exchange rate. Debt is ambiguous with regard to how do you actually structure that. whilst you have movers who clearly have a vision, they have an anticipation with regard to what they want to do next, and absolutely they're starting to execute. And in the past, probably countries tried to do too much. They tried to say we're going to do everything in one presidential term. I think now you're starting to see more clarity come from countries like South Africa and Nigeria, have both clearly articulated there are specific things we're going to achieve, and we're going to do that over the medium to long term. As an investor, that gives you renewed confidence. You then have the movers, and I absolutely would take the point with regard to Morocco. I think Morocco has moved and absolutely has positioned itself ready and already starting to industrialize. Here in Kenya, in the heart of East Africa, clearly this country is on the move. As we heard from the First Secretary earlier, with regard to even just the simple thing of visa access, clearly this country understands what private enterprise requires, and they're putting together those ingredients to empower the public and the private to collaborate. So clearly, I think in the continent, we have some shakers, and they make me nervous, but we clearly have some movers, and we should celebrate that and try and encourage others to become movers.
Fantastic. Ewan, if I can stick with you, we keep hearing Africa is the future, but capital is still cautious. When we spoke early on, we had a chat about PE, but also private credit has had a great run. Easy money, fast deals, everyone came out looking like a genius. But now we're seeing a few cracks in private credit and also PE, especially with names like Blue Owl, being the poster child for things having not worked. My question is it just that the music has slowed down, or are we really seeing the bar close? And how is it showing up in your ability to get deals done today?
So, unlike Kasada, we don't build, so we tend to acquire. So a bit like this example here, we acquired with other partners, the Radisson Upper Hill. It was seen as being a market leader, but the capital stack wasn't correct for the business. It was siphoning off the opportunity, if you like, the profitability. It was taking away from the skill set and the benefits of the local team and making this business distressed. We could step in, we could restructure that capital stack, and we could then reposition it, and now it's successful on many, many indicators. So when I look at markets where there's a capital pressure, sometimes that creates opportunities, whether that's in equity, whether that's in private debt, or whether that's in commercial debt. Whereas we talked before, I think as was articulated by President Ruto earlier, there's a frustration about international capital markets and definitely the DFI community and how they could do more to bolster those kind of renewables, those recycling of physical as well as enterprises within the continent, and do more to enable the, as you say, that demographic opportunity we have, because we don't just want more people, we want stronger enterprise, we want stronger businesses, and ultimately, we want bigger economies in Africa.
Brilliant. Buhle, one of the things that Kasada has to manage very carefully is obviously the currency risk. You're in different parts of the world, big cities, Cape Town, and then of course capital costs. Dollar has declined a lot, especially over the last 12 months. And many people are talking about dollar debasement. Does that change your investment parameters? And how would you say these risks have evolved in the last 12 months?
Sure. I think we're obviously first and foremost a dollar fund. But I think when you underwrite, FX is not just it, right? You're underwriting for a macro where you are very clear about where the downside is, and the downside actually might not just be FX. We're sitting in South Africa where actually between one of our hotels is very dollar denominated, whereas others are very rand denominated. So either way, there's a bit of risk management between our assets as well. But I think in general, no matter how much you price in, I think the investment thesis is one thing. Mm-hmm. The true measure of actually being able to get returns out is the ability to sort of, on a daily or weekly basis, be very agile. And so that's more of an operational thing than anything else. So we look at the dollar, we price for it, we go, actually, this is what's happened in the last 3-4 years, this is what's possible. But the truth of the matter is we're underwriting more than just the dollar rand. We're underwriting a business where many other macro things could go wrong. Mm-hmm. So really, it's sort of it's a quadrant feel more than anything else.
And it's a holistic valuation, yeah. Ronak, I know we're running out of time. Last question, just to be fair. And if I can, 2 minutes, Tammy. literally.
I want to give time for one question as well in the
Okay,
audience.
then let's take the questions from the audience
Okay,
instead
thank
of
you
me
so
asking
much.
you the question.
Thank you. Do we have a question
Anyone
in
from
the
the
audience?
audience?
Quickly, otherwise she's going to take the opportunity. Quickly. Okay,
Yes,
you-
there's a gentleman in
There
the
we
back.
go. There
Yes,
we go.
please.
Let me come through to you quickly.
Kasada as a private equity fund, what is your exit strategy for sub-Saharan Africa? Because you, 8-9 years into the fund, what is the plan? What are you going to do in a couple of years' time?
We're not 8-9 years into the fund, actually. We're actually way newer than that. I think from a possibility perspective, we're exploring all opportunities. You guys will see, to be honest, more than anything else, we're a fund, everything traditional is looked at, but also really thinking about our assets from a regional perspective as well, and where we sort of see value. So we're 6-7 years in. We still have a bit of runway, but we are looking at all opportunities.
Any other questions?
We don't have time for another one,
Okay,
unfortunately.
then we're going to wrap it up. All three of you, I'm going to give one sentence, and I would love a one-word answer, really fast and furious, fastest fingers first. Ready? I'll start with you, Ronak, because you didn't get the last question. Biggest myth about investing in Africa? Go.
I think you need the right relationships to be successful in Africa. But the one thing that didn't come up, and I would like to emphasize, is that we need to eliminate friction. There's too much friction in business in Africa.
Excellent. Ewan, if you could control one thing to unlock Africa investment, visas, airlift, or currency, what are you going to fix first?
Currency, because
Excellent.
currency leads to high inflation, and high inflation is the silent thief of all our pay.
Wonderful. Buhle, one thing you believed about Africa 5 years ago that you no longer believe today?
Africa lacks large scalable investments across the board, not just hospitality. I think we're heading in the right direction, and we have scalable products across the board.
Okay. Ronak, what's the uncomfortable truth investors say in private about Africa that never gets said on stage? One word, 2 words.
People say Africa is uninvestable. Yeah.
Not true. Hospitality in Africa, Ewan, undervalued opportunity or beautifully packaged headache?
As our mentor said, it's all about humanitarianism. We're going to put the human back in experiences.
Fantastic. Buhle, you get the last word. Finish this sentence. The next $1 billion in African tourism will be made by?
Platforms that have standardization and a clear, repeatable business demand.
Fantastic. You've been a wonderful audience. Thank you for
Thank
allowing
you
us
so
to run
much. A
over
round of
time.
applause, everybody.
Thank you.
Ronak, Ara, Buhle, and Ewan as they make their way off the stage.